Hello, everyone. My name is Nicholas Orr, and today I'm going to take you through a crash course on collateralized debt obligations, otherwise known as CDOs. I'll explain the history and initial development of CDOs, their impact on the 2008 financial crisis, the resurgence of CDOs, and what the future holds for these debt instruments. I'll also provide some other information relating to the 2008 financial crisis that helps to contextualize the CDO market, both past and present. This will include a background of the crisis itself, crisis management, and regulatory reforms. As with all things, CDOs had a genesis. CDOs were developed in the 1980s by investment firm Drexel Burnham Lambert. Their rise in popularity is often attributed to Michael Milken, otherwise known as the Junk Bond King, who was a Drexel Burnham Lambert executive. In 1990, the investment firm was actually forced into bankruptcy due to its involvement in illegal activities. Milken himself was sentenced to 2 years in prison and banned for life from the securities industry. Initially, CDOs focused on loan and company bonds, and their purpose was to conglomerate and securitize various debt assets for the purpose of redistributing credit risk. Over time, the CDOs evolved to include a much broader range of assets, which made them more complex and made investors less aware of the risks involved. CDOs are ranked into tranches. These tranches are set by rating agencies who give a CDO a rating based on how risky it is perceived to be. As you can see in this diagram, the higher ranked tranches are those that are listed as AAA, while the lower ranked tranches are those that are listed as B. Although it is not shown on this diagram, ratings can also go as low as C. Now, if you want a less risky investment, you would want to invest in a higher tranche CDO. However, you would also expect a lower yield as a result. If you invested in a lower tranche CDO, then you would have a higher expected yield, but the investment itself would be riskier. So for example, a AAA CDO could be made up of a bunch of mortgage-backed securities where the mortgagers are likely to make good on their debts and have good credit ratings. Whereas a B CDO might be made up of mortgage-backed securities where the mortgagers have lower credit ratings and are at a higher risk of default. So going more into the credit rating agencies. On the right, you can see some of the most famous or infamous credit rating agencies. These include Moody's, Fitch Ratings, and Standard & Poor's. Agencies such as these played a key role in CDO growth. These agencies were particularly generous with their ratings. This is because the agencies themselves were paid by the issuers of the financial products that they were rating. This created a conflict of interest, as agencies had financial incentives to maintain good relationships with issuers to secure future business. As a result of these generous ratings, investors were lured in. Essential investors included hedge funds, insurance companies, and pension funds. An investor would buy a AAA CDO believing that it was a low-risk investment, when in reality, it was a much riskier investment that had been concealed due to rating inflation. Due to this rating inflation, again, CDO market expanded rapidly, and investors sought diversified risk options for improved returns while managing credit risk. Moving on to synthetic CDOs. Synthetic CDOs emerged as a new innovation in the 1990s. They are derivatives of traditional CDOs that use credit default swaps to capture value. Now, the key difference between synthetic CDOs and traditional CDOs is that traditional CDOs are based on real assets. Take the CDOs based off of mortgage-backed securities, for example, right? Those mortgages are based on real assets, that being a home, right? However, synthetic CDOs used derivatives. They could enable speculation on credit events without owning the underlying assets. Now, creating a synthetic portfolio through credit default swaps, synthetic CDOs dealing with credit default swaps you could bet on credit worthiness without actually, owning those referenced entities, right? So you don't actually have to have a owning stake in it to be able to bet on that credit worthiness. The popularity of synthetic CDOs skyrocketed due to their flexibility and potential for higher returns. Financial institutions favor them for their exposure to credit risk factors, again, without the actual asset ownership. So I'm going to show you all a video real quick from The Big Short. I know a lot of people enjoyed this video in particular.
Switched to Liberty Mutual and saved hundreds. I know, exactly. What are you doing? Okay, so here's how a synthetic CDO works. Let's say I bet 10 million on a blackjack.
10 million because this hand is meant to represent a single mortgage bond. Okay, Selena has a pretty good hand here, showing 18, dealer showing 7. That's a really good hand for Selena. Good odds. In fact, her chances of winning this hand are 87%.
So my odds are good. I'm on a winning streak. Everybody in this place wants to get in on the action. How could I lose, right?
Now, this is a classic error. In basketball, it's called the hot hand fallacy. The player makes a bunch of shots in a row. People are sure they're going to make the next one. People think whatever's happening now is going to continue to happen into the future. During the real estate boom, markets were going up and up, and people thought they would never go down.
So people who are watching and think that I won't lose will make a side bet. Now, this is the first synthetic CDO.
I love Selena Gomez. Bet you 50 million she wins. And I'll give you 3-to-1 odds.
3-to-1 odds? Okay, I'll take that bet. Now, somebody else is going to want to make a bet on the outcome of their
Bet you
bet.
50 million she wins.
That will lead to synthetic CDO number 2.
Hey, I bet you 200 million that lady in the glasses wins that bet.
She probably will win. So I want a great payoff.
How about 20-1?
Deal.
And this will go on and on with more and more synthetic CDOs.
And we can transform an original $10 million investment into billions of dollars.
You okay?
So essentially, that kind of gives you a general idea of how synthetic CDOs work. Another idea to put it into context is that synthetic CDOs are kind of like naked options, in that you don't actually have to be owning the asset to be able to bet on it, right? So next, we're just going to go over a brief overview of the 2008 financial crisis. Of course, we have the rapid property price increase that occurred in the mid 2000s. That housing bubble with swift property price escalation. This was fueled by an increased issuance of subprime mortgages by financial institutions. There was also an eager provision of adjustable rate mortgages. Financial institutions enthusiastically provided adjustable rate mortgages to borrowers with poor credit histories, and interest rates were often adjustable and later increased to higher levels. So a lot of these adjustable rate mortgages not only led to people defaulting on their mortgages, but they were also predatory in that on the surface, they seemed like really good deals with really low interest rates that were meant to lure people in that maybe had lower credit ratings. However, over time, as is stated, the interest rates would get higher and higher, and so it was kind of like a trap for people if you think about it like that. Next, you had the struggles of homeowners. As interest rates rose and real estate prices declined, homeowners faced financial challenges. Many were unable to meet their mortgage obligations, leading to a surge in defaults and foreclosures. And then, of course, you had the unsustainable dynamics as a result of all of this, created an unsustainable situation, triggering a rising wave of mortgage defaults and foreclosures. So now we've got the turning point in the crisis, right? 2008 signaled the pivotal turning point and was also a pivotal moment in the history of CDOs and synthetic CDOs. Fueled by an influx of subprime mortgages, the housing bubble burst with disastrous consequences. The collapse of the housing market acted as a major catalyst for the subsequent global financial crisis. Now, CDOs and synthetic CDOs played a crucial role in both starting and worsening the 2008 financial crisis. CDOs, especially those backed by subprime mortgages, played a crucial role in deepening the crisis in that there was a high demand for CDOs and mortgage-backed securities, which fostered risky lending practices that we just talked about, right? Those loans that were made to borrowers with lower credit scores. Synthetic CDOs exacerbated the financial crisis by allowing investors to speculate on credit events without owning the underlying assets, right? I've said that time and again. That's the key thing that makes synthetic CDOs different. As the value of synthetic CDOs became closely tied to the occurrence of credit events, such as defaults on referenced entities, the financial losses amplified, intensifying the impact on investors and contributing to the severity of the economic downturn. Furthermore, some risky practices really, led to this situation and allowed it to get as bad as it did. The legislative environment essentially gave the green light to the expansion of risky lending practices, particularly the Community Reinvestment Act in the 90s, other legislation like that, the relaxed regulations, encouraged financial institutions to extend mortgages to subprime borrowers. Financial institutions also sought to capitalize on the lucrative mortgage-backed security market and threw caution to the wind, contributing significantly to the housing bubble. And rating agencies were willing to inflate tranche ratings in order to procure business. The combined impact, the combination of high demand for CDOs, driven by the allure of mortgage-backed security profits, rating inflation, and legislative changes, laid the groundwork for the widespread issuance of subprime mortgages. This combination significantly contributed to the housing bubble and ultimately the devastating impact of the 2008 financial crisis. Now, if you don't already know what a mortgage-backed security is, just to clarify, that's basically a bundle of mortgages that is sold off, and those are what the CDOs in 2008, the ones that really worsened the crisis. That's what those were based on, right? So next, you have the consequences of their actions, right? Of course, there's going to be consequences. Plummeting value of mortgage-backed securities. These housing market dynamics caused both the mortgage-backed securities and the CDOs to plummet as a result, since the CDOs were tied to these mortgage-backed securities. This resulted in significant financial losses for investors and institutions alike. A banning of the CDO market. CDOs were heavily involved in the crisis due to their broad exposure to those mortgage-backed securities, right? And the complexity of the CDO structures and the opacity of underlying assets made risk assessment challenging. As a result, investors and institutions struggled to accurately evaluate the risk level of subprime mortgages, right? So these investors basically viewed CDOs as toxic, right? They can't accurately evaluate the risk. They know that there was scandal with the rating agencies, right? So they get out of the CDO market because they simply don't have enough information to evaluate whether CDOs are going to be safe. So consequences for financial institutions. The widespread exposure to CDOs had serious consequences for financial institutions globally. On the right, you can see photos from the collapse of Lehman Brothers specifically. That was a big day in the financial crisis. Workers at Lehman Brothers were escorted out of their offices with their supplies and belongings in hand. It was a big big press event. So with that said, you have firms like Lehman Brothers, of course, that had to face the consequences, but you also had institutions such as Bear Stearns that the government decided to bail out. So after the 2008 crisis, you've got crisis response measures, right? The government had to take response and try and ease this crisis. You've got unprecedented measures. The severity of the 2008 crisis led governments and central banks worldwide to take unprecedented measures that aim to stabilize financial markets and prevent total economic collapse. You had rescue and intervention, TARP, and other unconventional monetary policies that worked in conjunction to try and ease the crisis. With rescue and intervention, governments launched a series of these measures to assist distressed financial institutions, and their objective was to restore confidence in the financial system. You've got TARP, Troubled Asset Relief Program, which provided capital injections to troubled banks and financial institutions. And again, as I stated, you have those unconventional monetary policies, including purchasing mortgage-backed securities and other securities. Finally, with restoring stability, these measures were focused on restoring stability to financial markets and promoting lending. So here you can see a graph diagram of the Troubled Asset Relief Program and what areas it targeted. It didn't only target these areas, but these are some key areas that the Department of the Treasury was focused on handling. So up here you've got capital purchase program for banking industry, loan to auto industry giants like General Motors Company and Chrysler. You got term asset backed security loan facility and home affordable modification program for credit market. Financial support to struggling families for limiting foreclosures, and finally, the purchase of AIG's preference stocks. So after the crisis is taken care of, government wants to make sure that this kind of thing is prevented from happening again, hence regulatory reforms. You've got the reevaluation of the regulatory framework that existed. The framework specifically for financial institutions and their complex products. You had global reforms. Governments and regulators globally implemented reforms addressing vulnerabilities of CDOs and related instruments. They wanted to reduce systemic risks, increase transparency, and strengthen risk management practices. And finally, you've got Dodd-Frank Act, right? Dodd-Frank's Wall Street Reform and Consumer Protection Act in the U.S. introduced comprehensive measures. They created regulatory agencies like the Consumer Financial Protection Bureau and established the Financial Stability Oversight Council. Dodd-Frank is one of the most famous regulatory reforms from the 21st century, and it has really shaped the business world in a very impactful manner. So some more regulatory reforms. You got the Volcker Rule. Volcker Rule, a key provision of the Dodd-Frank Act, aimed to prevent excessive risk-taking by banks. It restricts proprietary trading and ownership or sponsorship of hedge funds and private equity banks. You've got Paul Volcker in this little New Yorker comic on the right, who was the chairman of the Federal Reserve from 1979 to 1987, and he was instrumental in getting this rule put in place. The impact on CDO trading, regulatory reforms, their impact on that. Volcker Rule specifically, its implementation directly affected the trading and structuring of CDOs and related products and aimed to make them more transparent and safe. And finally, you've got the Basel III Accord developed by the Basel Committee on Banking Supervision. It imposes higher capital requirements on banks. It focuses on enhancing the resilience of global banking system, particularly addressing complex financial products just like CDOs. So, with this regulation, you had notable successes and failures. Starting with the failures, the collapse of Archegos Capital Management Family Office in 2021 highlighted the potential for regulatory failures related to complex financial products. Right, Archegos employed highly leveraged positions in equity derivatives, which bore similarities to the leverage and risk taking seen in structured finance products. The incidents raised questions about the effectiveness of regulatory oversight and risk monitoring in the financial industry. So, Archegos essentially was touted by the man who ran it in this image right here, Bill Huang, as a way for his family to invest money, essentially a personal family fund, right? And through doing this, he was able to find a loophole in the system where he could bypass certain parts of the Dodd-Frank Act and kind of get past the SEC through claiming that his offices were family offices, right? So through this loophole, he managed to manage over $30 billion in assets, and basically commit fraud. So I'm going to show you a little video on Archegos right here that kind of explains the situation.
Make complex trading less complicated. Custom scans help you find new trading opportunities, while an earnings tool helps you plan your trades and stay on top of the market. E-Trade from Morgan Stanley.
1,000 family offices managing $6 trillion around the world, some of them bigger than hedge funds, but they don't have nearly the same oversight. And that's because as part of the Dodd-Frank legislation, family offices won a special carve-out from Congress that allows them to avoid any SEC registration as long as they serve a single family and they don't give investment advice. Now, family offices made the case to Congress at the time that they only make conservative investments to preserve family wealth, and they don't try to beat the markets. Now, Archegos did not make a single filing with the SEC throughout its entire history, despite placing those billions of dollars in bets. Now, some family offices are required to disclose their share filings through 13Fs to the SEC, but that is only if they own more than $100 million in stocks. And attorneys tell me that rule is not always either understood or followed, which Wilf would be a generous explanation for why Archegos made these huge bets without anyone knowing about it.
It would, but I would also say that whilst I totally agree with the gist of what you're saying, and that seems like their behavior was as aggressive as it could come, and it was only meant to be long-term preservation of wealth. But the other key point there is, as long as it's the family's own money and they're not giving anyone else investment advice, those are probably two more powerful and important factors which do apply here and do explain why it could be understandable why they should face lower levels of regulation than a financial advisor or a typical hedge fund.
True, but if you look at how family offices have grown up, both in terms of size and sophistication, if part of the role of the SEC and the government is to understand systemic risk, if we have now $6 trillion that is effectively a shadow hedge fund system, we used to talk about the shadow banking system, then maybe there could be some kind of broad disclosure when you reach, let's say, $1 billion or some threshold, which is now technically required but not always followed, just again to better prepare the landscape for what could be some systemic risk because of their size.
No, for sure. Size and to your main initial point, the types of trading they're doing. Is it just tracking the market, or is it aggressively trying to beat single day moves in massive stocks? Robert, thank you so much.
Shepard Smith here.
So that video kind of explained a little bit about the regulatory environment and how they were thinking about responding to this Archegos crisis that happened. So we talked about the failure, right? But of course, there's success stories of regulation. You've got the stress tests conducted by regulatory authorities, such as the CCAR, Federal Reserve's Comprehensive Capital Analysis and Review, which have been instrumental in assessing the resilience of financial institutions to adverse economic scenarios. These stress tests have helped ensure that banks maintain adequate capital levels and risk management practices. So this diagram on the right here kind of shows some facets of the CCAR that are meant to ensure an effective capital adequacy process. You've got sound risk management, effective loss estimation, clear available capital resource estimation, capital adequacy impact aggregation, capital policy and planning, strong internal controls, effective governance, and sound risk management. So after all this regulation, and after the CDO market basically tanking as a result of the 2008 crisis, CDOs finally reemerged. They evolved and adapted, and despite the regulatory reforms of 2008, managed to find a place in the new financial landscape. Financial institutions adapted these products and sometimes rebranded them by adjusting underlying assets and risk profiles. Post 2008, financial institutions adjusted CDOs and synthetic CDO strategies to align with the new regulatory environment. This exploration of alternative structures and asset classes was used to generate returns while mitigating risks. So an example of this is shift to commercial mortgage-backed securities. Some institutions shifted focus from residential mortgage-backed securities to commercial mortgage-backed securities in CDO structuring. It was driven by the perception of lower risk in commercial mortgage-backed securities compared to residential mortgage-backed securities after the housing market collapse. Commercial mortgage-backed securities are fixed income investment products that are backed by mortgages on commercial properties rather than residential real estate. They can provide liquidity to real estate investors and commercial lenders alike. Now, the reason that people saw commercial mortgage-backed securities as less risky is because of the idea of a constant income stream for a business, right? Investors felt, these businesses are less likely to default because of their constant income stream that for some reason they thought was more reliable than, say, a constant income stream that a person might have that they use to put towards their mortgage. However, a good thing to keep in mind is that these securities could also be viewed, if you think about it, as more risky because you got the corporate shield, right? You've got corporations that are willing to be riskier and maybe not pay the mortgage on their property. Because they know that individually the members of the corporation aren't liable, right? It's just the corporation itself. So through their reemergence, there was a resurgence of what are called collateralized loan obligations, or CLOs. The CLOs provide higher returns in a low interest rate environment, and they offer entry into corporate lending without direct lending. Concerns raised about concentration of risk and potential crisis due to excessive leverage and credit quality deterioration. So kind of that issue that happened with the CDOs. People raise concerns. They say, maybe the same thing's going to happen with CLOs, right? Now, CLOs are similar to CDOs, but they're structured differently in that their primary focus is on commercial loans to companies with lower credit ratings. There's also some CLOs that don't focus on this area specifically, but that's the most notable type of CLO. As a result, people know that CLOs primarily target companies with lower credit ratings, so it's a lot more transparent, right? It's a lot more simple and transparent, and so this may enhance risk awareness and prevent a crisis similar to 2008, right? In 2008, people thought, no way the mortgage market's going to fail, but with these CLOs, it's a lot more transparent in its risk. Some more concerns and criticisms, though. There's concerns about a potential concentration of risk and subprime lending to businesses in pursuit of higher yields, right? So giving loans to businesses that are even worse off than the businesses they already give loans to. But however, current evidence suggests that the CLO market is stalling at about $1.5 billion. But critics warn of potential risks in a low interest rate environment. So, an especially interesting kind of reemergence is the emergence of what are called hidden CDOs. Financial institutions seeking yield in a low interest rate environment have innovated by bundling various loans into securities that's akin to past CDOs. These new structured finance products, often termed hidden CDOs, bundle diverse loans such as auto loans, student loans, and leveraged loans. With these hidden CDOs come new controversies and systemic risks, right? The complexity and lack of transparency in underlying assets raises worries about market instability and liquidity issues during stress. So there was that lack of transparency in the CDO market in 2008, and these hidden CDOs kind of mimic that, right? You take auto loans and student loans, and when you bundle those, it's kind of hard to keep track of everything, right? Even more so than it would be to keep track of a home loan. So this poses new concerns. Now, one of the most interesting concerns regarding hidden CDOs is the specific risk in student loan based hidden CDOs. They face notable risks, especially related to potential policy changes. Government forgiveness of student loan debts could significantly impact the value and performance of these structured products. Large-scale forgiveness of student loan debt may lead to a decrease in the overall value of these securities. Investors holding these instruments may face losses, and the broader market could experience disruptions due to the sudden shift in the financial landscape, right? So the hidden CDOs interconnectivity with broader economic policies emphasizes the importance of considering potential systemic consequences when implementing major policy changes. So just imagine for a second, say you have, the hidden CDO market, and these CDOs are based off these student loans, right? You go off and you forgive these student loans, market has the potential to completely collapse, right? Because you're basically getting rid of all the debt. You're kind of pulling out a rug from underneath the market's feet. So that's a particular concern with these hidden CDOs. On the right, you can just see some past student loan forgiveness measures that the executives taken particularly in 2022, toward the end of the COVID-19 pandemic. You had some historic actions taken by President Joe Biden to forgive some student loan debt. All right, so next is the the attempts to skirt regulations in the CDO market, right? So you always have this cycle, right? Crisis crisis happens, government tries to introduce regulations, and finally companies adapt to these regulations and try and get past them, try and skirt them, try to weasel their way around them, right? And this goes on, and just like in the past, it happened in 2008, right? Same process. So in an attempt to skirt regulations, the investors and financial institutions have devised several methods of doing this. You've got shadow banking, offshore financial centers, and regulatory arbitrage, just to name a few. Shadow banking is a system of financial intermediation outside of traditional banking. In regards to CDOs, you can engage in maturity transformation akin to traditional banks, but there's looser working capital and liquidity requirements, especially for CDO creation and management, right? With offshore financial centers, you can use those for activities with fewer regulatory restrictions. They're characterized by favorable tax regimes and less stringent financial regulations. These offshore financial centers can serve as conduits for CDO structuring with greater flexibility and fewer constraints. You've got locations like the Cayman Islands and Bermuda, which offer a conducive regulatory environment for optimizing CDO structures. Finally, you've got regulatory arbitrage, which is similar to offshore financial centers, and that involves exploiting regulatory differences between jurisdictions, institution structure, and managed CDO transactions in jurisdictions with less lenient or more lenient and less stringent regulations. Popular locations include Luxembourg and Ireland, offering a regulatory environment facilitating CDO activities with reduced scrutiny and potential lower compliance costs. A particularly interesting way that investment institutions are trying to skirt these regulations is through what's called decentralized finance, or DeFi, and this is going to be a key player in the future. So keep your eye on this. Cryptocurrencies and the DeFi landscape are closely interconnected. So if you aren't really familiar with decentralized finance and you've heard the term cryptocurrency before, that has something to do with it. You've got companies already like Opium Finance who are using the decentralized finance landscape to introduce CDOs using the DeFi system. So what this DeFi landscape is, it's basically online interconnected system that like the name suggests is decentralized, right? There's a lot less control in regards to the system. This decentralized nature promises increased financial inclusivity and an increase in efficiency, right? Efficiency gain in the transaction process. However, as you could guess, with a decentralized, new incoming market, there's going to be regulatory challenges. There's a lack of clear regulatory framework that poses a real challenge for lawmakers, and the emerging nature raises the questions about the legal frameworks and investor protection. The synthetic financial products in crypto, thinking back to synthetic CDOs, right? You can create those without traditional intermediaries. Cryptocurrencies and DeFi have the potential to facilitate the creation of synthetic financial products and derivatives without relying on traditional intermediaries. There's some parallels to traditional finance as well, similar complexity and risk profile, as seen in synthetic CDOs. These different synthetic financial intermediaries they could possibly rely on. But it also raises the concern about systemic impact and regulatory oversight in the evolving digital frontier. So if my explanation didn't do it justice, here's just a little explanation from Forbes that will teach you just a little more about DeFi.
With Grammarly Business's Secure AI, insightful prompts and suggestions help you get more done and
DeFi is a term for the next generation of digital financial services and products that is being built on and enabled by blockchain technology. So blockchain technology is the overall innovation behind Bitcoin. And Bitcoin you could think of as the largest use case of blockchain technology today. Blockchains have gotten much more sophisticated. And they enable much more complex financial use cases and applications. These new use cases are called dApps, decentralized applications. When you think about DeFi apps, it's greater than the parts, right? It's not just a collection of these dApps, it's an interconnected ecosystem. And the goal of DeFi is to create a new financial system that is fully digital native from the beginning. It's going to be faster. It's going to be interoperable. It's going to be more transparent. It's going to be global from day one. Anyone around the world can use these financial products and services, accessible to anyone with an internet connection. So a good way to imagine the long-term impact of DeFi is to think about it in comparison to the internet in the 80s and 90s when it was getting started. The people who used the internet in the very beginning, they were people who were diehard technologists, right? Because the internet was very difficult to use. There were all these chat rooms, there were bugs. Over time, though, what you saw was the internet is that these early adopters, they seed it, they're the first users, they invest in these protocols with their dollars, and they attract VCs and investors like me who pour more investment money in, and we finance new technologies, we finance new, better user interfaces that make it more palatable for the average American, the average user. And eventually, it's just like the internet. There's going to be so many people online and the experience of the internet will become even better and better than non-internet experiences for certain use cases, right? Like for e-commerce versus retail, that the mainstream starts to adopt it. Everyone starts adopting it. The front end of our financial system is beautiful and it's all on smartphones and it's all on apps and it's digital native. You go on Robinhood, you go on Schwab or E-Trade, but the back end is very clunky. The back end hasn't changed in decades or if not longer. It's basically just switch operators, like running things over phone and very old technology systems. This, I think, is one of many things that DeFi and blockchain technology will solve. You won't have to have your back-end provider call you on the phone if you're Robinhood, tell you that this is a problem. They'll know that it's a problem days or weeks in advance. And so even with us in America, we're seeing the problems and the little cracks that can be quite big with what happens when you have a fast digital native front end, but a very slow, creaky, not digital native back end.
All right, so hopefully that kind of explained the DeFi landscape a little bit more to you all. So next you've got risk management in today's economy and contemporary challenges. Going into kind of the cybersphere, with cybersecurity, right? So we just talked about DeFi, and now you have to focus on how you're going to kind of protect the cyberspace. The digitization of financial services and the increasing reliance on technology introduce cybersecurity challenges that directly impact the CDO ecosystem. Financial institutions involved in creating, managing, or investing in CDOs are vulnerable to cyber attacks that can disrupt operations, compromise data security, and erode investor confidence in structured finance products. A cybersecurity breach targeting a major financial institution could have cascading effects on the CDO market, causing disruptions and undermining trust in the security of these financial instruments. And this isn't just some looming threat that's never really happened. There have been instances of targeted cyber attacks on financial systems. Even countries have done this. The nation of North Korea actually has its own elite hacker force that has already stolen billions of dollars through coordinated cyber attacks from financial institutions. Next, you've got global economic interconnectedness. The global economy's interconnectedness has direct implications for the CDO market, as events in one region can have far-reaching consequences. This interconnectedness can transmit financial shocks and risks across borders, impacting the valuation and performance of CDOs. The Eurozone debt crisis had reverberations on global financial markets and affected the pricing and demand for certain types of CDOs. So you've got all this risk, right? Got to manage it, right? So in recent years, financial institutions have increased their efforts in implementing more stringent risk management procedures. This can come in the form of advanced technology that might oversee and mitigate risks that come with structured products like CDOs. A kind of interesting development in this could be the introduction of artificial intelligence that's actually able to kind of oversee and evaluate this risk. Regulators and industry participants have placed a significant emphasis on enhancing transparency in the market. This has been achieved through imposing greater disclosure requirements and reporting standards aimed at ensuring that investors receive access to pertinent information that enables them to evaluate the risks associated with structured products. These measures were implemented by the FSOC, Financial Stability Oversight Council, in 2014. And in this image on the right is the FSOC, and of course you can see second to the left is a figure that many will be familiar with, Ben Bernanke, right? Nobel Prize winning economist. Finally, looking at future prospects. Trends in financial innovation. Financial innovation continues to evolve as it always has, with the potential to introduce new structured products and derivatives that may impact the CDO market. Innovations such as blockchain technology, tokenization of assets, and digital securities could reshape how CDOs are created, traded, and settled. For instance, you could use the blockchain technology in the issuance and tracking of CDOs, which could enhance transparency and streamline processes, potentially addressing some historical concerns related to opacity and complexity in the CDO market. Of course, in the future, we'll need to adapt to this new area of innovation through regulatory responses. Regulatory authorities must remain adaptable in responding to emerging financial innovations and risks, with a particular focus on their implications for CDOs. Regulatory frameworks need to strike a balance between promoting innovation and assuring the stability and integrity of the financial system, including the structured finance sector. Finally, technology will play a pivotal role in shaping the future of financial markets, including the structuring, trading, and oversight of structured financial products. For example, as I stated, machine learning algorithms and AI could analyze vast data sets related to CDO performance, improving the ability to identify early signs of stress or instability in these financial instruments. Through this crash course, I hope you all have learned a good deal about CDOs, their impact on the 2008 financial crisis, as well as where they stand today. Through this information, hopefully, you can maybe even navigate the structured finance sector yourself and become more knowledgeable investors in the future. Thanks for watching.